Historically, Indian markets have always been dependent on foreign money. If FIs invest, the market jumps. If FIs exit, the market falls. However, in last few years, especially post-COVID, the equation has changed completely. Indian market has witnessed a massive rally post-COVID, and that too, it wasn't driven by foreign investors. It was largely driven by domestic money. Retail investors, mutual funds, DIIs, they were consistently buying. On the other hand, FIs were consistent sellers. And somewhere along the way, a narrative started building that maybe India has become self-reliant. Maybe we don't really need FI money anymore. However, in last 18-20 months, reality has been slightly different. In spite of massive buying by domestic investors, Indian markets have underperformed big time. Especially, the broader market has witnessed sharp corrections. If you look at the specific data, over the last 5 years, DIIs have invested around 21 lakh crore into the market, while FIs have actually pulled out close to 12 lakh crore. And this selling has only intensified since 2024. Especially in 3 months of 26, FIs have already sold investment worth 1.88 lakh crore. So the question is, if domestic money is so strong, why is the market still struggling? It clearly suggests that Indian market cannot sustain only on domestic flow. We need FII money. In fact, everyone wants to know when the Indian market will bottom out. And for that, one of the key is FII flow. So in today's video, we'll try to decode two questions. First, why FIs are consistent sellers from Indian market? And second, when will FI return to India? Because the moment FI reduce their selling or they start investing again in the Indian market, we will see the Indian market bottoming out and ready for another bull market. Alright, let's get started. First of all, we need to understand that FIs do not look at Indian market individually. They look at India as part of emerging market basket. This emerging market basket includes countries like China, Taiwan, South Korea, Brazil, and of course India as major constituent, and remaining small quantities in other countries. Now, just like every investor, FIs look at two key data points: valuations and earning. Historically, Indian market have delivered double-digit earning growth, roughly around 12%. And Indian market have traded at median PE in the range of 2022. So that's a PEG ratio of less than 2. Now what happened is, during 23-24 period, Indian market witnessed a crazy bull market. As a result, the valuation got stretched. Nifty touched PE of around 24-25 and mid and small cap index became very expensive. Now the catch is, during 24 phase, when Indian markets were expensive at PE of 24-25, other emerging markets like China, Taiwan, South Korea were available at very attractive valuation. For instance, Shanghai index was at PE of 10-11. Taiwan touched PE of below 10 in October 22. South Korea index was at PE of below 10 in May 25. So the first reason for FIs to switch from India to other emerging market was valuation gap. Indian markets were expensive as compared to historical median, whereas other emerging markets were available at much better valuation. Then second reason was slowdown in earning growth. Always understand that FIs do not look at valuation in isolation. They look at valuation in relation to earning growth. So in last few quarters, India's corporate earning growth has slowed down from double digit to single digit. So on one side, valuation got stretched to PE of 24-25. On the other side, earning fell down to 8-9%. That resulted in a PEG ratio of around 3. On the other side, countries like Taiwan and South Korea have witnessed strong earning growth. And one of the key reasons is AI impact. While India could not cope up with AI revolution, and in fact, in an IT sector that was one of the biggest wealth creator for India, has witnessed massive slowdown due to AI disruption. On the other side, countries like Taiwan that has TSMC, which is one of the biggest beneficiary of AI capex boom. In fact, today TSMC has highest weightage in MSCI Emerging Market Index, followed with Samsung, then Tencent, then SK Hynix. The only two Indian stocks in this list are HDFC Bank and Reliance. And since TSMC contribute nearly 40% of Taiwan's market cap, high growth in TSMC resulted in high earning growth in Taiwan market. Likewise, Samsung and SK Group together have 60% weightage in South Korea that are again beneficiary of AI capex cycle. As a result, while India's corporate earning witnessed slowdown in last few quarters, other emerging economies have witnessed higher earning growth. So the second reason for FI outflow was earning difference. But today, Indian markets are available at much better valuation with PE touching levels of 20 for top 50 companies. Whereas Taiwan is trading at much higher valuation and South Korea is also trading much above its historical median. So from valuation point of view, Indian markets have started to look quite attractive now. But the catch is earning growth. Just when we thought that worse is over for Indian market as Q3 earnings have started to show recovery, and market analysts were expecting double-digit growth for earnings for FY27. But then we witnessed US-Israel-Iran war. As a result, the crude oil prices have jumped crazily, and this is impacting India's earning growth because we import nearly 85% of our oil. So today, the market is discounting that impact, and hence FIIs have seen a massive selling from Indian market. So US-Israel-Iran war became the third reason for FIIs massive selling from India. Apart from these three reasons, fourth reason is weaker policy in terms of tax treatment. In 2024, Indian government increased the long-term capital gain from 10% to 12.5% and short-term gain from 15 to 20%. Now this might not be a massive change, but the problem is FIIs deals in billions and even a small change in taxation impact the profitability. Another bigger concern is the direction that has turned the sentiment negative for FII. Until 2018, long-term capital gain in India were completely tax-free for equity. Then government introduced 10% tax and now they've increased it to 12.5%. So that shows the direction is to increase it further in the future, which is clearly not a good sign. And of course, the way INR has depreciated against USD in last few years, FIIs have barely been able to make any money from India in last few years. FIIs are better off keeping this money in US bonds. So due to all these reasons, FIIs have been a massive seller from India. Now the big question is, when will FIIs come back to India? Let's discuss it. For FIIs to come back to India, it would require A, fair or attractive valuation, and B, double-digit earning growth. The good news is, valuation-wise, Indian markets have become attractive. Today, Nifty 50 is trading at a PE of 20, which is below its historical median. On the other side, other emerging economies like Taiwan, South Korea are now trading at much higher valuation as compared to their historical median. The only catch is double-digit earning growth for India is missing at the moment. Earlier, it was expected that FY27 should deliver double-digit earning growth, but US-Iran-Israel war has resulted in crazy jump in crude oil, and that is impacting every sector of India. So earning growth for next few quarters can remain subdued. Of course, a lot would depend upon how long this war continues and how long crude oil price remain elevated. If oil prices remain elevated above $100 for next few months, FI selling can continue. However, if crude oil prices cool off, we can see FI selling getting reduced. Then another angle is AI capex cycle. At the moment, AI capex cycle is in full force, where global hyperscalers have committed nearly $600 billion for capex in 2026. As a result, Taiwan and South Korea would continue to benefit from it, and their earning growth would remain high. However, the moment AI cycle would reduce, Taiwan and South Korea would see slowdown in earning growth. And since their valuations are already elevated, FIs would move that money back to India. So India would be a beneficiary of reverse AI trade. The only question is, when will AI capex cycle reduce? That is something only time will tell. And finally, I expect the Indian government to learn from their mistake of increasing the taxation on capital gain and make policies that can help attract FIIs to invest in Indian market. Overall, the picture is clear. Indian markets have been a huge underperformer mainly due to massive FII selling. And the selling happened due to expensive valuation versus other emerging economies and slowdown in earning growth. Going forward, for Indian market to stabilize, FI selling has to stop. And for that, the first immediate trigger would be US-Iran war. It has to stop because then only we'll see oil prices stabilizing. And once oil prices stabilizes to a comfortable level, India's earnings should improve. Then another aspect is AI capex cycle. India has been a laggard in AI innovation, whereas other emerging countries like Taiwan, South Korea have been a strong beneficiary of AI innovation. Going forward, when the AI capex cycle would reduce, India would be a beneficiary of reverse AI trade. And finally, I hope the government acknowledges how serious this FI selling is and they introduce some policies to attract them. Although I don't have much hope from government on this. So yeah, the situation is tough at the moment. Considering the geopolitical uncertainty, it's difficult to predict the exact bottom. But one thing that history suggests is every time Nifty 50 has touched PE of 20, it has given excellent return in long term. So from here, there might be another 5-10% pain left because nobody can time that exact bottom. But the risk reward are extremely attractive for long term investment. Personally, I'm 100% bullish on India's long term growth story, and hence for me, this correction is an opportunity. Now, I would love to know your thoughts. Do you think the market bottom is near? And are you utilizing this correction to buy more or waiting for the market to bottom out? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.